The median American income is about $5,000 a month, and most people think you'd need $1 million to earn that in retirement. But what if I told you that you only need $1,000 to start working toward that without ever selling a single stock? This video is about the lowest amount you actually need to live off Fidelity index funds, and it's probably less than your last vacation. I'll show you and John how to build a dividend-paying Fidelity index fund portfolio that can one day cover all of your living expenses. I'll break down the biggest mistakes people make when chasing dividends and the exact funds that I picked. In the end, I'll show you the lowest amount you need for index funds to pay over $60,000 in annual income and how to reach that same goal 10 years faster. But before we get into the numbers, let's quickly go through why index funds, even the boring ones, are probably the smartest way to build wealth for most people. When you think about getting rich, what comes to mind? Buying rental properties, picking hot stocks, maybe throwing some cash into crypto and hoping it pays off? And look, these can work, but they usually come with big risks, a lot of stress, and way more effort than people expect. Real estate sounds secure, but it's pricey. You need a big down payment, then you're dealing with tenants, repairs, late-night calls, unless you hire a manager, which then eats into your profits. Stock picking? Fun at first, until a surprise earnings report tanks your favorite company. And crypto? That's basically a roller coaster with no seatbelt. A single tweet can wipe out your gains. Now compare all of that to index funds. They're low cost, diversified, and super simple. Instead of betting on one company, you own hundreds. That spreads the risk and smooths out the bumps. No constant news watching, no wild swings. You buy, hold, and let time do the heavy lifting. It's one of the few strategies that actually works while you sleep. No, it won't make you rich overnight, but it's reliable, and over time, it builds serious wealth. And for what we're doing in this video, building steady, growing income, it's the perfect tool. But before you start picking funds, there's one mistake people make when they hear the word dividends. When most people hear dividend investing, they instantly think find the highest yield possible. A fund paying 7% or even 10% sounds like a dream, but here's the truth. Those numbers can be a trap. High yields often come with higher risk and weaker fundamentals. If a company or fund is offering unusually high payouts, it's usually because the market doesn't trust it to grow. In many cases, the share price is stagnant or falling, and investors are being compensated for that risk with a bigger check today. But what happens if that dividend gets cut, or if the underlying investment crashes? Suddenly, that safe income vanishes. This strategy flips that mindset. Instead of chasing short-term yield, focus instead on total return, a combination of three factors: dividend yield, dividend growth, and share price appreciation. It's not what you earn today, but how much that income grows and how much your portfolio is worth years down the line. Let's put it in context. A fund with a 2.5% yield, growing dividends at 15% a year and steadily appreciating, will outperform a higher-yielding fund that doesn't grow. Why? Because compounding multiplies your reinvested dividends and your future income. That's how you build a dividend engine that scales with you. But for that, there's a criterion for choosing the right stocks or index funds, which matters a lot. So how do I actually pick the right index funds? It's not about chasing the hottest trend or reacting to the latest market headlines. The portfolio isn't built on hype. It's built on three key performance principles designed to maximize total return and income over time. First, reliable dividend yield. I start by choosing funds that offer a steady, healthy payout, not too low to be meaningless and not so high that it screams risk. This yield is the foundation. It's your starting income, the money you earn simply by holding these investments. It needs to be consistent, stable, and paid out regularly. Next is strong dividend growth. This is huge, and it's where a lot of people miss out. The best funds aren't just paying dividends, they're growing their dividends. I prioritize funds with a strong 10-year CAGR in dividend increases. Why? Because that growth compounds your income. A 15% dividend growth rate means your payouts double roughly every 5 years, building serious income over time. Then there's share price appreciation. I'm not just looking for cash flow, I want my portfolio to grow in value too. Share price appreciation builds wealth. It protects your purchasing power and increases your long-term returns even if you never sell. I included funds with strong historical growth across various market conditions. And here's the last layer: diversification. I choose funds that expose you to different segments: U.S. mid-cap stocks, European giants, real estate investment trusts, undervalued mid-caps, and small micro-caps with breakout potential. This blend spreads risk and captures growth from all angles, not just one. Now remember, in the end, I'm going to show you the lowest amount you need for my portfolio of index funds to pay over $60,000 in annual income and how to reach that same goal 10 years faster. At this point, you might be wondering, well, why not just invest in the S&P 500? It's one of the most common strategies, and to be fair, it's great for building long-term wealth. You're getting exposure to the 500 biggest companies in the U.S., and historically, it's delivered solid returns. But here's the catch: if your goal is to live off dividends, meaning consistent spendable income, the S&P 500 simply doesn't deliver. Let's break it down with real numbers. If you built your portfolio from major S&P 500 ETFs like SPY, VOO, and IVV, your average dividend yield would be around 1.27%, dividend growth at 6.36%, and share price appreciation at 10.85%. Now let's say your goal is $60,000 per year in dividend income. That's $5,000 a month. Here's the math. The required investment equals $60,000 divided by 1.27%, which equals $4,724,409. Yikes. You'd need to invest nearly $4.72 million to hit that goal. Now, even if you stretch the timeline out to, say, 30 years, you'd still need to invest around $750,000 just to earn $60,000 a year or $5,000 a month from S&P 500 dividends alone. Why so much? Because these ETFs are designed more for growth than income. Most of their returns come from rising share prices, not regular cash payouts. If you want to live off those investments, you're forced to sell shares over time, which isn't sustainable or predictable. Now compare that to what we're building here. My portfolio is designed differently. It touches on funds with respectable starting yields, stronger dividend growth, and healthy appreciation. That means your money not only grows, but also pays you increasingly higher returns over time. And here's the key: you're not relying on selling your assets to live, you're creating an income engine, one that keeps paying you without eating into your principal. And that's exactly why this strategy works. You don't need millions. You just need the right mix, a solid plan, and a little patience to let it do its thing. So what does that right mix actually look like? Well, it starts with a simple formula that drives real wealth: dividend yield, dividend growth, and share price appreciation. This trio creates the engine behind everything. You want a portfolio that pays you today, grows that income over time, and also increases the value of your investments in the background. When all three are working together, you're no longer just investing, you're compounding toward freedom. From real index funds that check all three boxes, I've handpicked 5 Fidelity index funds that work together to create a high-performance income machine. And here's how each one plays a role. First up is the Fidelity Mid-Cap Index Fund, FSMDX. This one's the income grower. It pays a solid 2.27% dividend, and that dividend is growing like crazy with 23.67% growth over the past 10 years. Add in 6.53% average price growth, and you've got a foundation that builds itself. Next is Fidelity Zero Extended Market Index Fund, FZIPX. It gives you a modest income with a 1.19% yield and nearly 20% dividend growth. Its price growth is slower at 5.08%, but it adds some international exposure that helps diversify and balance the portfolio. And then there's Fidelity Zero Large Cap Index Fund, FNILX. This one's reliable and steady, 1.02% dividend yield, 17.21% dividend growth, and an impressive 12.09% price appreciation. It's built on large, stable companies that keep delivering over time. The Fidelity Zero Total Market Index Fund with the ticker symbol FZROX adds some aggressive growth potential. While its 1.09% dividend yield isn't the highest, its dividend growth of 19.21% and appreciation of 11.6% make it a high upside asset that accelerates compounding without dominating the overall risk profile. And finally, Fidelity U.S. Sustainability Index Fund, FITLX, adds a strong ESG component. Its dividend yield is around 1.22%. It has delivered about 18.07% dividend growth and approximately 10.68% annual share price appreciation. That makes it a stable, socially responsible way to balance the portfolio with inflation-resistant benefits that align with long-term goals. When combined, this portfolio delivers an average dividend yield of 1.36%, a 10-year dividend growth rate of 19.62%, and an annual share price appreciation of 9.2%. All right, now let's get to the fun part, how much this portfolio can actually grow over time. So let's start small, really small. Imagine you only have $1,000 to invest. That's it. No big inheritance, no six-figure income, just a one-time deposit anyone could realistically pull together. From there, let's say you add just $1 a day. That's $30 a month or $360 a year. It's slow, it's steady, and most importantly, it's sustainable. Now, most people wouldn't expect that to go very far, but this isn't about quick wins. It's about how compounding turns small seeds into big results. Based on projections, here's how things will play out. In year one, your portfolio will grow to $1,466. Not massive, but it's a start. By year 10, your total contributions will be just $4,600, and your portfolio will already be worth $9,183, nearly double your money. By year 20, you'll have invested about $8,200, but your portfolio will reach $45,287. That's when the growth really starts to take off, and then comes the leap. After 30 years of steady investing and reinvesting every dividend, your $1,000 start and those small, consistent contributions will grow into a portfolio worth $441,188. By that time, your portfolio will pay $79,729 in dividends, and that's about $6,644 per month. The total value of the portfolio would be worth $429,388, and you would have collected a total of $150,793 from capital appreciation, and $278,595 would have come purely from reinvested dividends. Let's look at how to reach the same $5,000 a month income goal, but 10 years faster. For this, instead of starting with $1,000 and adding $30 a month, you need to start with $20,000 and commit to contributing $20 a day. By the end of year one, your portfolio will already grow to $29,411. That includes your initial investment, your first year of contributions, and the gains. And from there, it just keeps building. By year 10, your portfolio will grow to $185,396, and by year 20, your total contributions will reach $93,000, but your portfolio will be worth $914,971. That's almost $1 million nest egg built without any extreme sacrifices. Also, around the same time, your portfolio will generate $68,698 in annual dividends. That's about $5,725 per month. And if you decide to take those dividends as income instead of reinvesting them, your portfolio will still be worth $748,971. Of that, $452,013 will come from capital appreciation and $296,957 from reinvested dividends. Want to get paid every week starting next week? Click the video on the screen to find out.